Hi everyone, Ryan Jones here, and today I want to show you how to easily and safely make 3 to 5% per week by exploiting a proven spread strategy applied to weekly options. Now this spread strategy carries small and limited risks. It has a very high probability of success. There are dozens of opportunities each week. Each spread has a profit potential that is 1 to 7 times greater than the risk, and it takes very little capital to implement. So what I'm going to do is I'm going to give you an example. We're going to get right into this by giving an example of a recent trade I made. This particular trade was in STX, and the absolute worst case limited risk on this trade, no matter what happens, is only $15. The absolute best case profit potential, so if it goes absolutely perfect, the absolute profit potential is $124, and that means that the ratio of profit to risk on this particular spread, the potential, is 8 to 1. And then of course the time frame is 7 days, since these are being taken on weekly options. Further, this trade would make money whether STX moved up or down during the next 7 days, creating a very high probability of realizing at least some sort of profit. And the only way this spread can lose is by moving a very significant amount in one direction by the expiration date. So as long as it stays within a very reasonable 7-day range, the probability of some sort of success is very high. So how did this trade end? Well, I exited the trade in 6 days for a profit of $32, or a 213% return on my risk. In fact, during this particular week, I had 8 trades with 6 winners and 2 losers. And if you were to risk just $200 on each trade, here's the outcome of each of these trades. So I've listed here 8 trades. Begin with XOM. If I risked $200 on XOM, I would have made $104. Now, I say would have because I risked more than $200 on these trades. So I'm saying if you only risked $200 on each of these trades, then this is the amount that you would have made. I risked more and I made more. So XOM, $104, or 52% if you risked $200 on the trade, worst case scenario. STX, if you only risked $200, you could have made $424 by taking this same exact trade that I did take, and I risked a lot more than $200 on that particular trade. Here's a losing trade. We risked $200 on the trade, and the potential of actually realizing the maximum risk is very, very small. So in this particular one, we lost 55% of what we were risking. DNDN, $120. Amazon, 100% at $200. BP lost again on $60, or 30% of what was being risked. FSLR is $150 profit, and LVS is a $210 profit, or 105% return on whatever was being risked. So the total net profit, if you were to risk only $200 on each of these trades, the total net profit from these 8 trades was $1,038, and it would have only required an account size of $1,600 to make. And that means risking $200 on each trade only required $1,600 in your account to make these trades. Now these are not hypothetical fills; these are actual fills. And these are actual trades, actual results. The week before, again, if you were to risk only $200 on each trade, UNP, for example, $750 profit, 375% return. That was a very solid trade. Amazon, 24%. Amazon, again, we did calls and puts. 17% on that. Netflix, we did the same thing, calls and puts, 53% and 52%, so forth and so forth. And you can see the only loss there was CSCO. That was basically a break even. And the total net profit for that week, if you were to only risk $200 on each trade, was $1,836, and it would have only required an account size of $2,000 to make all of these trades and risk $200 on each one. Again, all of these are actual fills. These are not hypothetical. Now, each of these trades, the risk was limited, the probability of success was stacked in your favor, and the profit potential exceeded the maximum risk by a factor of 3 to 8 times. In fact, I don't take a trade if the profit potential isn't at least 3 times what my risk is on that particular trade. And each trade took very little capital to implement, and I'll get into more of that here in a bit. Now, what are these trades based on? They're based on time spreads or calendar spread strategy that was designed to exploit the faster rate of time decay that occurs in weekly options. But you can't just throw any of these time spreads on and expect these kinds or this kind of high probability, low risk trade. What I'm going to do is I'm going to show you exactly what to look for that will stack the odds heavily in your favor. Now, 2 years ago, the CBOE introduced weekly options for the first time on a select group of stocks. So this strategy and this opportunity was not even available just 2 years ago. And when they did it, they only did it on a small group of stocks. The volume wasn't very good. And over the last 2 years, that has steadily increased to where now there's 150 stocks that you can trade weekly options on, and the volume is pretty good across the board. So this is a tremendous opportunity, and these options start trading every Thursday morning and expire the following Friday, 7 trading days later. So every Thursday morning you have new potential trades come on the board, and they expire in 7 days. Now, one major characteristic of options is that time value or extrinsic value of an option decays faster as the option comes closer to the expiration. So here's a little chart, if you will, that kind of demonstrates or illustrates the rapid increase in the rate at which time decay occurs in an option the closer it gets to option expiration. You can see up here that the slope is not very extreme, but the closer you get to the option expiration, it almost goes vertical. So here we are. Here's 30 days at this point. Here's 7 days. It's almost the line at which the time decay occurs is almost vertical at that point. So essentially what we are doing is we're looking to exploit this advanced rate of time decay each and every week, but while dramatically limiting our risks to do so. Okay, so let's take a closer look at the STX trade I mentioned earlier. On October 25th, we sold STX 28 call November 2 expiration, or November 2nd expiration, for $124. So we brought in $124 into our account. At the same time, we bought an STX 28 call November 16th expiration for $137. So we paid $137. So our net debit on this trade was 13 cents or $13 based on one spread option. So this was entered on 10/25, and at the time that we entered it, the STX was basically trading right at $28. So this was an at-the-money spread. Now, as long as both legs of this spread are exited by the close of November 2nd, you cannot lose more than $13 per spread position. So this is a very limited risk trade. Now, it's important to note that both legs of the calendar spread always trade the same strike, and both are either calls or either puts. So when you buy and sell, you're buying and selling, everything is the same except for the expiration date, and that's the only difference between the two options that you're buying and selling. So very important that you understand that. A debit spread is when you buy the longer term option and you sell the nearer option. So you need to also remember that. Now, there are two important things you need to notice about this particular spread. The first is how close the price of the options are. you'll notice that the November 2nd option is 90% of the November 16th option as far as the price is concerned. So if you were to divide these into one another, you would come up with the exact number. 124 is 90% of 137. Okay, so second, the remaining time on the November 2nd option is only 33% of the remaining time on the November 16th option. Okay, so there's 7 trading days left on the November 2nd option, whereas there are 21 trading days left on the November 16th option. What you have there is you have a situation where the price is very close, but the expiration dates are a lot further away. These two things combined are very, very powerful. So on November 2nd, STX closed at 28.02. So this is the expiration date. We entered on October 25th. On the expiration date, STX closed at 28.02 and the spread closed at 67, or over 5 times what the spread was bought for. We bought it for $13. It closed at $67. So exactly what has to happen for this spread to win, and what has to happen for this particular trade to lose? Now, based on the option values at the time, the break-even range of this trade was approximately $26 and $30, meaning that as long as STX closed within this 14% range of the strike, so within 7% higher or within 7% lower in just 7 days, then the spread will at minimum break even on the November 2nd expiration date. Okay, so it had a $4 range that it could close in, and you would at least break even. The closer to the strike price that it closed, the greater the profit potential for the most part of that particular spread. But here's the deal. So as a spread, or as a stock is moving toward that break-even point, as it moves towards the break-even point, it actually causes the spread to widen prior to expiration. This usually gives several opportunities to exit at a significant profit prior to expiration. So for example, on STX, on October 31st, STX took a dive and it moved down to $27. Now remember, it needed to close between $26 and $30 for this particular spread to basically break even or better, or make some money. So it took a dive, moved down to $27, and on that move down, the spread actually widened to 40, and I exited a partial position at a $27 profit per spread. Okay, so the spread went from $13 to $40, and I exited partial position of this spread for $27. So this was basically a tremendous opportunity for me to take out a partial position, which I did at the time. And what this means is that in order to get to the loss level, okay, in order to get to the 26 level, it has to move through 27. And it has to move through 27.50, and then 27, then 26.50, etc., etc. And as it moves towards the loss level, it has to move through a level that will most likely give you a profit. So in order to get to a loss, it's giving you a profit. That's why this is such a high probability strategy if you take the opportunity to exit when it gives you the profit potential before it reaches that level where it could potentially be a loss. Now, there is a situation where it doesn't have to move through there. Obviously, if the stock gaps, then you may not have an opportunity to get out at a profit, and that's where you can either break even or you take a small loss. That's something that one of the trades that I showed you, BIDU, where we took a 50% loss, what happened was the market gapped lower, and it gapped lower enough to where I could have exited for a break even, but I held on to see if it was going to bounce at all and bring it back to a profit. It did not, and so I ended up just exiting at a 50% loss right before the trade expired. So that is, that's the instance where we could lose money on these, or more likely will lose money on these, is if the stock gaps far away one morning and doesn't give us a chance as it's moving through that zone that gives us a profit level. Had STX closed at $27 on November 2nd, as opposed to moving, it moved to 27 on October 31st, so with still 3 days left on the option. That's really what enhances the profit potential, is that it does it early. And had it closed at 27 on November 2nd, the spread would have been at approximately 26, which means we would have taken, we would have still been able to take a profit of $13 or 100% on the trade. But by exiting during the move prior to expiration, our profit potential at the $27 level was actually greater. So that's a little tidbit secret, if you will, that you need to know, that when a trade is, or when a stock is making a move, that's usually when the profit potential is presenting itself. So you just have a limit order in place for 1, 2, 3, 4 times the maximum risk, or you can divide it up. There's a lot of ways to do it, and there's no right or necessarily wrong way, because you don't know exactly what's going to happen. But my suggestion is that you always take the opportunity to exit at least half the trade at 100% profit that ends up bringing the rest of the trade to a break even no matter what happens. So as I stated, for this trade to become a loss, it has to move away from the strike, and while it's moving toward the loss level, it has to first move into a profit, as long as it doesn't gap and as long as it doesn't wait too long to do it. Usually if it waits too long to do it, it presents a profit potential anyway, because it's still at the money, right? So just all sorts of ways to take advantage of this. And by doing so, it further increases the probability, as long as you have chosen the right spreads in the first place to take. So let's take a another quick look at another example. On 1025, we also made the following trade. We sold Amazon 230 calls, November 2nd expiration for $10.10, and we simultaneously bought Amazon 230 calls, November 16th expiration for $11.45. So our net debit on this was $1.35. So we were risking $135 on this particular trade per spread. The max profit potential per spread was over $1,000. So our reward ratio here was 7.4 to 1. Now the following day, just 1 day later, Amazon shot up to 240. It was trading at 230 at the time that we made the trade. It shot up to 240, and the spread increased from 135 to 270, and we partially exited that particular spread for $135 profit, or 100% return, in just 1 day. And then on November 2nd, the spread closed. This was like 5 days later. After this, the spread closed at 460, giving us about a 300% profit on that particular leg. So another classic example of how this works. If Amazon had shot up to 240 and we exited, and it continued to shoot up to the point where it produces a loss on the other half of the trade, unless it produced the maximum loss on the other half of the trade, we were guaranteed to make something by getting out of half the trade when it reached 100% return, which happens a lot in these trades where the risk is the reward ratio is big like this. 7.4 to 1 reward ratio, that's a big ratio. Now we can look at these examples all day long, and in fact there are dozens of opportunities each week thanks to the inception of the weekly options. The key is to only take the highest probability option spreads, and then to take advantage of any opportunity to bring the trade to a break even when presented the opportunity. So you exit half the position at 100% profit, and that increases your overall probability of success tremendously. Now, the key to successfully trading the strategy is finding the right trades when they are available, and this is why I had my own software program to quickly find and trade the spreads to meet the criteria that I'm looking for, because there's almost nothing out there that allows you to do it in a time efficient manner. So I just finally got tired of looking for anything out there, and I just had my own program built, or programmed, software program programmed. And I'm going to show you this. Here's a screenshot of the day that we entered that STX trade that I've talked about, and the Amazon trade. This was 10/25 of 2012, as you can see here. That was the date. We're looking at calls. Here's the price. This is at 3:03 p.m. We actually entered the trade earlier that day. It closed at 28.12, and you can see the net debit on this particular strike at 28, where we sold the 11/2 expiration and bought the 11. This is actually, it's 11/16. They list it at the exchange as officially expiring on a Saturday, but it's actually a Friday. So on 11/17, and the sell price at 125 and the buy price at 141 for a net debit of 16. So we actually got in at a net debit of 13, and it closed that day at a net debit of 16. Here's the Amazon trading just under 230 at the close, and the net debit at 160. We actually got in at 135 earlier in the day. So this is how we found these particular trades, is through this software. Take a closer look. You can see this is the calls. It lists all the calls for 11/2 versus 11/17, and then it also lists all the other combinations as well if you want to look at the other combinations. But that spread ratio is really where we find the opportunities. I like to have spread ratios of 75 or better. And you have two ratios. You have the spread ratio, which is the price against the price, and then you have the EV ratio. And the EV ratio is the extrinsic value ratio. So some of these are in the money, and the ones that are in orange are in the money. The ones that are in green are out of the money. And the ones that are in green, that means that the price, the sell price and the buy price, and the sell EV and the buy EV are exactly the same. In other words, the entire price is extrinsic value. If it's in the money, that means that some of that price is intrinsic value. So what I'm looking for is I'm looking for the extrinsic value ratio. And here there's a $1.13 of extrinsic value on the sell option, and a $1.29 of extrinsic value on the buy option. So that's an 88%, so it's very close. So that's very good. And I'm looking for the EV ratio of anything over 75% as a general rule. Now remember, we want to look at the money, or as close to at the money options as we possibly can, because that clearly defines our risk, meaning that we are most likely within that range are going to see a profit as long as the stock remains in that range. If that ratio is below 75, then the probability of, or excuse me, if we're looking at in the money options, for example, or even out of the money options, we may not see the low of this spread or the debit. So we're looking to get into these with as little risk as possible, and that is what increases our overall profit potential. So here is a look at a more recent list of trades. This was on 11/2 at 9:09 a.m. and I believe 11/2 was a Friday. So Friday morning at 9:09 a.m. The options came on the board Thursday morning, so there was a whole host of option opportunities on Thursday morning, and here's another whole host of opportunities on Friday morning. And you just take a look at these. QCOM, for example, we have a net debit of 17, which means that our biggest risk, or maximum risk, is $17, while we have a sell price of $1.31. So our max profit potential is the sell price, which is $1.31 or $131. And you can take a look at these, and they're all very, very good. And then you have the spread ratios that are all very good. And I'm going to take a look at these a little closer here on the next page. But all of these arrows are the ones where the strike is very close to an at-the-money opportunity, and those are the ones that I want to take advantage of. Now, all of these, they're not at the money, but they can move at any time during the day to become at the money. So that's something that you can plan as you're looking at some of these as well. So anyway, these particular trades, I took all of these with the blue arrow, and just take a look at the risk versus the reward. So the QCOM had a risk of $17 and a profit potential of $131, or risk reward ratio of 7.7 to 1. JCP had a ratio of 7.85 to 1. AET 6.5 to 1. MCP 6.6 to 1, and so forth and so forth. Remember, the worst case scenario I want to take is at least a 3 to 1 ratio. And you look at UTX here, and you have a 3.4 to 1 ratio. Now, these are only the call spreads that existed at 9:09 a.m. on 11/2 of 2012. There were also 10 legitimate put spread opportunities at that particular time as well. So there are more than enough opportunities for you to take. But here's the crazy thing. The total cost to place one of each spread above was only $128, meaning you only needed $128 in your account to take one spread, to place one spread of each of these spreads. That's it. And you're only risking $128 if every spread loses the maximum amount, which is just would have to be a bizarre situation for that to happen. But if each spread was to lose the maximum amount, you'd only lose $128. Now, how crazy is that? Remember at the beginning of this video where I stated that you could easily and safely make 3 to 5% per week with this strategy? Let me give you some perspective. If you only make $4 combined across all of the spreads given above or previously, not individually, all together combined, a net profit of only $4, you will net a 3% return on the amount being risked. That is incredible. So what I mean here is that if the only trade you make money on is QCOM, and you make $4 on the QCOM trade, that's it, just $4, and you break even on all the rest, you have netted a profit of 3% in 1 week on the risk amount of $128. Okay, so that is, this thing absolutely doesn't do anything, and you still can easily and safely make 3% there. Now, you obviously don't want to max out your risk every week. So if you have a $1,000 account and you only risked one spread per opportunity, meaning that you only risked $128 if every spread went against you to the maximum amount in your $1,000 account, you would still only lose $128. So basically about 12% you're risking, absolute worst case scenario. And if each of the spread opportunities only has a 50% return on average, you achieve a 6.4% return, not on the amount being risked, but on your entire $1,000 allocation to this particular week. So can you safely and easily make 3 to 5% per week trading this strategy? Absolutely. Listen, for those of you who have been looking for a strategy that offers low risk, high probability, consistent, you can sleep at night type of success that doesn't take a lot of capital and is easy to implement, this is it. And if this isn't it, then I don't know what could be. Now, this isn't the holy grail. You aren't going to knock a bunch of home runs. You're going to have a few bigger trades every now and again, and I showed you a couple. but there are going to be weeks where you don't make money. But as long as you use the smart money management principles and follow my criteria for finding the right spreads, I don't know of an opportunity that provides a higher probability of long-term success than what I've revealed to you today in this video. If you're trading and you don't see this as one of the best trading opportunities that you've come across, I don't know why you're trading. This is a very, very incredible opportunity that I think every trader should consider to some degree. Now, the only question is, how will you quickly find the best opportunities every week? I had to have my own software program built, so obviously we can do it, and we are doing it. So what we're going to do is we're going to make available this information twice daily through web updates. So each day we post all the available call and put spreads to our website, once in the morning around 9 a.m. and once in the afternoon around 2 p.m. So it's during the day. You can check the website, you can see what opportunities are available, and make whatever trades you want to make based on those opportunities that you see. And we're going to make to the Platinum PDS Platinum subscribers only, we're going to make this available through November 30th, a 6-month subscription for $197, meaning you receive the updates twice a day, once around 9 a.m., once around 2 p.m. for 6 months for only $197 for that 6 months. Or if you would rather get a copy of the software that we use, that I just showed you, very briefly showed you, when it is released, which should be about the first week of December, you can pre-order your 1-year license to the software, and you can get updates as many times and at any time during the day that you want to find these trades. And the 1-year license is only $497 if you pre-order. That's basically $41 a month is what that comes out to have not only the spread updates but also the tool that we use to find them. And by the way, this tool will allow you to trade them through it as well. So it's a very easy process. It's a 2-click process. If you find the spread, you click on it, it pulls everything up automatically for you. You review it. If it's what you want, you click order or trade it, and it places that for you, and then you can exit them the same way. A lot of these trading platforms are very tedious in trying to create a spread opportunity. So the PDS tool is not just about finding the opportunities, it's also about making it very easy to trade them and to manage them. So that's something that's coming out again December, the first week of December. The thing is that this is through November 30th, and it's to PDS Platinum subscribers only right now. I haven't offered it to anyone else at this point. So the price is good through November 30th. There's no rush necessarily, but there is one small thing, and that is that it is being released. The tool is only going to be released to 250 during that first week of December. So only 250 are going to get the special $497 price. And by the way, the tool also covers the covered calls that you're getting. It finds the puts that we use. This is how I find the puts that I provide in the actual signals. And then it also provides credit spread calendar opportunities, which I haven't even covered in this video. I'll cover that in another video. But the tool provides all of that with weekly options. And you're not going to find this information anywhere else. You're not going to find any other software that does this. You're not going to find this information anywhere else. So it's a very, very valuable software program, obviously built specifically because I needed it in order to be efficient with how I trade these spread opportunities. So you can get 6 months of the PDS spread updates for $197 total, or you can get the PDS software, pre-order it for $497 for 1 year. And if you order the software, you do not need to order the spread updates. We'll automatically give those spread updates to you in addition to the PDS tool. So again, only 250 copies on that, and the next release, if you don't make the first 250, the next release will be the second or third week of January, and the price at that point is at $5.97. After the first week of December, the price goes to $5.97. To order either of these, the PDS tool, just go to this first link, and if you don't want the tool, if you just want the updates, then go to the second link and you can make those orders. And these links are also going to be included in an email, so you can just simply click on them. Alright, so I wanted to present that to you, and if you have any questions, please contact our support team or live chat during the day, and they'll be more than happy to help you out. I hope you found this information beneficial. Obviously, you don't need my updates or the tool. I revealed the entire strategy to you today, so you don't need it necessarily, but man, it sure will make life a lot easier, more efficient, and that's what we're providing for you. So, alright, I appreciate you attending this video, and trade smart.